Good afternoon, students. Today we are going to discuss about financial markets. As we have in yesterday's topic, we have one chart that should be categorized into four parts. Financial market is one of the part of Indian financial system. So, we will discuss what is the financial markets. Here, the chart. Yesterday we gone through the chart. Basically, if we have a question on Indian financial system, so that chart describe the whole things into the Indian financial system. So basically, we'll come to the topic that is financial markets. A financial market is a market in which people trade financial securities, commodities, and other fungible items of value at a low transaction cost and at a price that reflect supply and demand. Securities include stocks, bonds, and commodities include precious metals or agriculture products. So basically here we are going to discuss about financial markets. Yesterday we have discussed there are basically three type of markets, basically capital, money market, and derivative market. So these are the three major types. So capital market is basically categorized into two parts, primary and secondary. If we are talking about commodity market, commodity is basically again that should be traded in commodities such as metals, such as food grains, oil, and other things. So money market, which is for a shorter period of time, these are basically two types, organized and unorganized. Then derivative markets. Derivative market, basically derivative a is a asset, or we can say derivative whose value is derived from underlying asset. And another is insurance market, where we are dealing with the life insurance corporation or general insurance or health insurance, other things. In the last, we are dealing with the foreign exchange markets, where we are dealing with the foreign exchange currency. There are basically three types of markets. Yesterday we have discussed. So money market is a segment of a financial market in which financial instruments with a high liquidity, because that is for a shorter period of time, so it leads to high liquidity and very short maturities are traded. The money market is used by the participants as a mean of for borrowing and lending into a short term for several days to just under a year. Investment into money market is done throughout money market instruments. Money market instruments meet short term necessities of the borrower and provide liquidity to the lenders. Money market instruments are as follows. Basically, when we are talking about money market instruments are basically, there are two features. One is that is very of very short period maturities, and the second one is the liquidity, because there is no lock-in period, so we can liquidate the asset very easily. That can be convertible into cash in very easily. So these are the T bills, that is treasury bills. Yesterday we have discussed repurchase agreements, commercial papers, certificate of deposits, bankers acceptance. Another thing is capital market. Capital market we have already studied, that is for a longer period of time, that is have a lock-in period. So here the maturity is for a longer period of time, after a longer period of time, and here there is no liquidity. So, capital market is one in which individual and institutions trade financial securities. Organizations and institutions in the public and private sector also often sell securities on capital market in order to raise funds. Capital market can be divided into bond markets and stock markets. In bond market, buying and selling of newly issued and existing bonds take place. In stock markets, we can exchange stocks or shares. So in the last part, that is derivative market. Derivative market basically whose value is derived from an underlying asset. So derivative market is a financial market for derivatives, financial instruments like futures, contracts, options, which are derived from other forms of asset. The market can be divided into two. that of exchange traded derivatives and over the counter derivatives. The types of derivatives are forward contracts, future contracts, option contracts, and swaps. So what is the role of capital market? Basically, why we are investing into the capital market. So this is the role or functions of capital market. One is a mobilization of savings. We can easily capitalize the funds. Capital formation, we can put on the capital, as this is a mobilization of savings. For example, if I have a earning of rupees 30,000 per month, and I am saving rupees 2,000 a month, and that is having a lock-in period of 5 years. So I will save every year. I will save 24,000 for 5 years. I will save 1,20,000. Plus, there is a capital gain, the appreciation in the money. So it will help in capital formation. Provision of investment avenues. It will help us to create a provision for the investment avenues. We can invest into the various type of investment avenues, such as fixed deposits, such as recurring deposits, such as Kisan Vikas Patra, such as national saving certificates, such as equity shares, bonds, debentures. So we can invest anywhere. So there are many investment avenues. Speed up economic growth and development. It will help us to put on capital means that will increase the value of you can say capital gain. So it will help in economic and economic growth and development, because it will lead to employment generation, because we are investing into the huge funds. Service provision, this will provide a service provision. Basically, here we are investing money into the service sector, not into the product sector. So it will majorly include services only. So these are the function of financial markets. Basically, if we want to, you can say, if I am a lender, you are a borrower, you can directly take money from me. Or the second thing is, there is an intermediary in between. I will lend money to the intermediary, and intermediary lend the money to the borrower. So basically, this chart, if we can explain by this chart, there are basically two type of finances. One is direct, another is indirect. If we can go by that indirect, so there is a financial intermediary which will follow the financial market rules, and the other second option is we can buy directly, or we can lend the money to the borrower directly. So basically there are two things. So here on the right hand side, allows transfer of funds from person or business without investment opportunities to one who have them. The second one is improve economic efficiency. So this will basically, these are the benefits of financial markets. So I think that is very simple topic. You can study. If you have any problem, you can ask me your problems. Thank you for listening.